now we have another amazing, and yes, I'm going to be using that all day because I am so thankful for all of the coaches at Tackle Trading. Our one and only Canadian friend. No, I'm kidding. We have lots of Canadian friends, but our Canadian coach, Coach Greg Holmes, Mad Dog, Greg Holmes, Money Greg. What else are we calling him these days?
I don't know. Just don't call me late for dinner and we'll be friends. So
I'm with you on that one, buddy. I'm with you on that. I'm blaming COVID for the 15, but that's just a lie. I've been enjoying it. But Greg, you're going to be talking about covered calls here. You know, and I know you love those dividend-paying covered calls, but the covered call in general, I'm going with Mad Dog. I love that one. And, just tell Greg Justin Trudeau's prettier than him, and he'll show.
Oh Jesus! You always got to start a fight, don't you, Matt?
I do.
It just reminds me of that saying, and that's how the fight started. You brought up JT. So anyway.
Hey, we got to laugh, right? We got to laugh at it all, right?
Absolutely. I'll make you cry if you don't. So
everybody, let's give a warm welcome to Coach Greg. Greg, take it over.
Awesome. Thanks, guys. I've been ducking in and out here all day. It amazes me every time us coaches get together and have a chat, whether it's doing the reports on the weekends or, you know, when we've actually got together live, and just to hang out with this brain trust is phenomenal. It couldn't ask for more from my standpoint anyway. Glad to be on the YouTube live with you guys. This is so much fun. I just can't believe that I have the privilege of doing this and privilege of hanging out with you guys. So, you know, today I want to talk about covered calls, but I want to approach it in a way, last couple of days, I always get these questions, but the last couple of days I've gotten a lot of questions about, you know, starting with small accounts, you know, building portfolios where you can use covered calls to increase your wealth. You know, there's so many little things that you can do and not do that it's important that we kind of break that down into into a, I don't want to call it a mind map, but kind of like a series of if thens where you can say, okay, we can do this, that, or the other thing. Like one of the things I get from a lot of students is, you know, maybe I'm only starting with, you know, $2,000, $5,000, $10,000, whatever it is, whatever your small amount that you're starting with. If you know, it doesn't really matter. There's great stocks out there that are low dollar stocks that can still have great fundamentals, that can do great covered call cash flow, all those kinds of things. So there's really the reason I like the covered call strategy is you know, I started out as an investor before I became a trader. And so when I learned that you could be an investor and still add some cash flow strategies and start compounding your wealth in a way that, you know, as a financial advisor, you know, many years ago, when I sat down with my clients, I had to give them a realistic number of what they could make in a year using, you know, the products that I was exposed to. And then once I came along and learned something like the covered calls, you know, it took that and it just amped everything up. And if you know the laws of compound interest, the reality is you can start small and end big. It's just like rolling a snowball downhill. You know, it starts out awfully small. You give it enough time and enough velocity, and it's going to grow massive. So anyway, we're going to start there. Like I said, I've got a couple of little stocks I want to show you guys. Things for, you know, it doesn't matter if you've got a small account or a large account. Okay, what it means when you've got a smaller account versus a large account is you're going to look for certain things if you have a smaller account. If you have a larger account, then you're going to look for certain, you know, cash flow dollar amounts. Okay, so really the techniques and the trades, they're virtually all the same. You know what I mean? Like we're not really going to change too much. Now you might change the price levels of some of the stocks you choose to use, but the reality is the system is the same, and it's how you look at it and how you put it together that makes it, you know, it's the magic's in the mix, so to speak. So let me see if I can share my screen here and see if we can't do something crazy here. All right.
Greg, let me know if you need an American to help a Canadian.
Well, yeah, I do. I'd like you to come shovel snow whenever you can get away from Hawaii there, big guy. So feel free. That's the help I require. You let me know if you're up for it, though, eh? So anyway, thanks, Cody. All right, let me get to a whiteboard here first. Hopefully, actually, I might need your help here, Cody. I need you to tell me if you guys can see this. All right.
We're currently seeing toss right now. So
okay.
Did you share the window individually or share the entire screen?
Yeah, that's a great question. I think this will work.
There you go. We got the whiteboard up.
Whiteboard. Awesome.
It was all sarcasm until he actually really needed help there.
Yeah, well, hey, I told you guys
when we it all the funnier.
I told you guys when we met, these computer things are not my friends. So anyway. All right, so let's talk about this.
Presented by Taco Trading, how you can be computer illiterate and still be a wonderful trader. There you go.
Exactly. Yeah, there's what I learned from Taco Trading and all these great coaches is there are no limits. The only limits are yourself. So, all right. So let me get a pen going here. All right, so we're going to start with wealth. If I can, again, get my actual pen to work here. I apologize for the writing. It's really not that great. I probably should have used a Word document, but that's okay. I think you guys will get the point. So I like to split this up into two kind of factions. Now, don't get me wrong. There's so many other things. There's so many asset classes. There's real estate. There's businesses. There's all sorts of things. But we're gonna talk about the paper. I'm gonna talk about the paper because that's what we're all here doing. When you start talking about paper, you kind of split into two camps, okay? So, you get your long-term kind of, I want to say long-term investing mindset, okay? You get that, and then you get your traders, okay? Now, I've had this debate, a million times with a million different people of, how, covered calls, lean more to the left than they do to the right. Now, I'm going to hopefully show you guys tonight that that's not really the case. I'll tell you something that, and I know this come from a few of the coaches here as well, that, if they could start their careers all over again, they might focus a little bit more on these cash flow strategies than maybe the trading that they started with. Not that there's anything wrong with either one, but if you can build your wealth over time, it becomes to such massive numbers that it's almost hard to believe. And I think Matt's going to talk a little bit about that a little later on. But I'm just gonna show you how I break this stuff down, and then kind of look into a couple of little different stocks that I found that I think you guys will enjoy, and just show you kind of the covered call process. And I want to show you the numbers. I want to show you the power of it. That it really can, like I said, you don't have to have $1 million to start doing this stuff. You don't even need to have hundreds of thousands of dollars to start doing it. You can start small and grow big. And that's really what we're all after. So, when you start talking to long-term investor, okay, we're gonna look at this from a cover call perspective on both ends here. Okay, just put cover call here in the middle. Okay, so a covered call for a long-term investor. Okay, basically what they're trying to do is they're trying to enhance their portfolio. So call that enhance. I'm probably going to run a ton of room here, but whatever, we'll make this work. So they're trying to enhance it. Whereas a trader, okay, they might be looking for a specific return on investment, specific return on an ROI, okay? And so I'm going to show you guys a couple of different trades. One where a trader can be satisfied, and one where a long-term, and when I say long-term, it doesn't have to be 20, 30 years down the road. It can be, but it can also be 2 years, 5 years, whatever your time frame is. The beauty of the markets is there's something in there for everybody. Okay, I know that my view of long-term wealth might be different than Matt's, or might be different than Cody's, or might be different than Mark's. You know what I mean? But it's all because we come from different backgrounds. But the reality is we can all reach our goals, whatever they may be, through the same strategies and the same education, the same work, if you're willing to put it in. So when we start talking about long-term investing, you just have to break things down in a little different manner. When you start to enhance yields or enhance ROI, okay, you take the average long-term investor, maybe they're buying a stock, right? You buy a stock like, when everybody knows this is one of my favorites, but I buy a stock like Coca-Cola, and I think the dividend's somewhere in the neighborhood between 3 and 4% right now, okay? So for some long-term investors, that's all fine and dandy, right? 3 to 4%. For most of us, that's not moving the needle. That's not we're not putting any parties together for 3 or 4%. So the way we go and enhance that is by using a covered call strategy. Well, maybe on something like Coca-Cola, you're only going to get 1% per month, okay, approximately. It's not always going to be that much, but it won't always be that low either, okay? You get 1% a month. Well, all of a sudden, when you add in the dividend and 1% a month, okay, then you're looking at 10 plus, okay? That will start to move the needle for most people, okay? I can tell you that because I've dealt with a lot of people where they would have, run over their own grandmother for 10% or better, okay? So the long-term investor, they want to enhance it. Whereas traders, and this is very, very possible, there's opportunities out there, even for the smaller accounts, where your ROI can be shooting to 3, 5. I've even seen 6%, on some stocks, just doing a covered call. That's a pretty darn good return for doing something, pretty basic for a covered call. A covered call, for those who don't know, you're basically buying some stock, and you're making a promise to give your stock away to somebody else, and you're gonna do that for a certain length of time, and they're gonna pay you to do that. Now, for those of us who know what covered calls are all about, that's not a revelation. If you're brand new to this concept, which I can tell you from speaking to a lot of people, most people have never even heard of this. You know what I mean? Like a covered call, unless you get into that trading realm, a lot of long-term investors that I know have never even heard of a covered call, but it has a lot of power to it, okay? So when we start talking long-term versus traders, we have to start thinking in different ways, okay? So a long-term investor, you've got to look at things a little bit differently, okay? And we're gonna go through a little bit of this. So fundamentally, if I'm gonna hold a stock, for any length of time, year, 2 years, 5 years, 20 years, 30 years, I've got to understand that fundamentally that stock is strong. Okay, so there's things I'm going to be looking at, right? I'm going to be looking at its balance sheet, right? I might be looking at its products. Okay, I might be looking at its management team. You know what I mean? The management team is a big deal. If you got a great product, but you got people that can't manage it, it tends to do rough things over time, right? So fundamentally, I'm probably looking at all these things, okay? And I need to ensure that, like I said, if I start looking, let's say long-term can be anywhere from 2 to, let's say 35 years, okay? If I'm looking at that, I need to make sure that these stocks that I'm willing to buy, the risk that I'm willing to take, because the risk in a covered call is that you basically risk the shares going to zero. So, the old example I always use is Blockbuster. Okay, Blockbuster went to zero. There's a lot of people back then that probably would have thought they were pretty fundamentally sound, right? We need to make sure that we have a process, which I'm going to kind of go through a little bit tonight, provided I can not talk too much, to show you guys kind of how I look this stuff up to make sure that things are kosher, okay? I also want a history of quality, okay? And that means different things to different people. I'll show you guys what it means to me. I want a history of quality, okay? So with this here, fundamentally, I need this, the stock to be strong, okay? I'm probably going to ride through, okay? I'm going to ride through any rough patches, okay? If it's still fundamentally sound, okay? And then this is something you need to check on. I'm going to ride through rough patches, okay? I'm not going to dump my stock, every time it takes a 3% correction, okay? I'm going to ride through the rough patches. I'm going to be holding this long term. And my job is to get my break-even price down to zero, okay? Because if I get my break-even price down to zero, okay, meaning I own the stock for free. And I said, how many shares do you want if they're free? I would hope that you would say all of them. Okay. That's kind of the long-term perspective that I see when you start thinking about a covered call. Now, on the other side of this, we got the traders. Okay. And most people, at least most of the folks that I've met through Tackle Trading here, the community members, they're going to be a combination of both of these. Okay. And there's this, I know I'm a combination of this, so I would expect that everybody else would be as well. Okay. The traders, okay, they're going to say, you know what, I want a little more bang for my buck. Okay. I know Emily was on there and she had some covered calls on. I know she's big into those as well. The Iron Condors, all these kind of things. What they're looking for is a little more juice. Okay. You know, that 3, 4, 5, 6%. There's some, I've even seen some bigger covered call numbers than that, but you got to start watching your risk a little bit there when you start seeing it a little bit, too much higher than that. So they're going to look for a specific ROI. So fundies, as Gino calls them, fundies might be less important, okay? Because their job is going to be to keep this stock or position for a certain length of time, okay? So maybe they pick up a stock, they hold it for 30 days, they collect an ROI, and then they dump the stock, okay? Or they have a stop loss on it. In this one here, like I said, they're not going to ride through any rough patches. They're going to have a stop loss at a strategic level. Okay. And so when you start thinking like this, when you start thinking like a trader, you've got to start thinking, okay, what is my end game here? And it's the same on both sides. The long-term guy has an end game and the trader has an end game as well. Their end game is to jump in, collect some cash over 30 days, nice little cash flow trade, and move on to the next trade. Okay. These guys on the left here, they're gonna collect some cash. It's gonna be less, but they're probably gonna do that over and over and over again on that stock. Okay. So with the specific ROI, like I said, the fundamentals are less important. I wouldn't say not important. I would just say less important. They're probably going to use a stop loss or some other technique to offset the risk. Okay, they're going to know their risk parameters very, very carefully. Okay, you've got to know that stuff before you get into any trade, but especially one where you're not willing to hold the stock long term. Okay, so you start to look at this stuff and you start to think, okay, how do I manage all of this stuff? Okay, so I'm going to show you a couple examples, like I said, of the something that I would look at longer term, and then we'll look at a couple of stocks too. And what I did here for you guys is I chose specifically some names that you guys will know of companies that are lower price points, so that you can see that you don't have to have a boatload of money to be able to get into this strategy. Okay, it can work for everybody. Okay, so let's start with the longer term investor. Again, there's a whole avenue or path where you could start building a large portfolio of this, and sometime in the near future, I'm hoping that for Tackle, I can put something together for you guys so that you can actually see, how to start building this stuff up and kind of a step-by-step process. That's my plan going forward anyway. But today I'm just gonna kind of show you a few things where you can start to put some of these things in place and really, like I said, even if you've got a small account, you can start to make some money off of this stuff, and I think you'll find it enjoyable. All right, so I'll leave that there. You guys will have that. Let's gotta get my pen out of there. All right, so hopefully you guys can see Thinkorswim. Let's see, I'll go back and I'll reshare this to make sure. And we go there. Okay. All right. All right. We're back at Thinkorswim. So hopefully you guys can see Thinkorswim now. Okay. So I want to talk about the fundamental part of long-term investing. Okay. Like I said, for me, I've always spent a lot of time delving into, what's a good stock versus a bad stock. And when I say bad stock, I just mean, not something I want to hold for 30 years. You may not have that same time frame, and that's completely fine. I don't have an issue with that. But if you do, maybe you're one of these folks that maybe you've got a job. Okay, if you've got a job that you got to go to, maybe you need a system where it requires less management. Okay, if that's the case, then something where you're going to hold something longer term and you're just going to work on it, at a certain frequency, every couple of weeks, once a month, whatever the case may be, then this kind of stuff can work really well for you. But if you're going to hold something, you really got to start delving into the particulars of it. So I'm gonna, like I said, I came up with a couple of stocks here. Let me see. I gotta make sure you guys can see this. Let's go screen. Hopefully you guys can see this. Can you guys see Google by chance? Anybody?
Yep, we're looking at Google right now.
Awesome, thanks, Cody. Okay, so the first place I want to start, and I'm gonna use one of my favorite dividend-paying stocks. Okay, so you don't have to use dividend-paying stocks. I just personally like them. All the guys know that I'm a big fan of. I'm a big fan of getting paid to invest. Okay, that's what I like about the cover call situation too. I'm a big fan of getting paid to make promises. I'm a big fan of getting paid to basically just paid to put my money somewhere. That to me seems like a really good idea. Okay, so there's one stock here that I looked up for you guys. It's a low dollar stock, so the barrier to entry is not horrible, right? It's called Enterprise Products. Again, this is not a recommendation or anything. This is just something I found. It's an $18 stock that has a lot of the qualities that I like. Okay, it's something that I believe has a future to it. Okay, and there's ways that we can look into this stuff and see, okay, is this thing going to be solid longer term, or is this maybe going to be a short term trade? These are all the considerations we have to take care of, right? So the first thing I like to do, I go to Yahoo Finance and I want to look at the financials of this thing. I want to make sure, is this thing going to be around in 2 years, 5 years, 10 years, whatever the case may be. Okay. So I go in here and I want to look at a few things. All right. And I'm going to make this very, very basic because really I could take you down a rabbit hole where we could do this for hours. It's not always necessary to do that. You don't have to do a deep dive into value all the time. Now, there are ways to do that. Sometimes you could just look at a few things and get an idea of what you're looking at. And that's really what I'm going to show you guys tonight. So when I think about a healthy company or a healthy country or a healthy household or a healthy, personal, situation, I always think that if you got more income going in than you got going out, that's probably a good thing. So that's kind of where I start with these companies to say, hey, are they doing well or are they not doing well? So what I'll do is I'll go and I'll typically look at the income statement. Okay. And what I'm looking for is, are they making money? Okay, so you guys can see here, I don't know if you can see it real well, but basically they've got data from 2016 all the way up to 2019, and they got the trailing 12 months here. Okay, so I just want to look at this and I want to say, okay, what's my net income? Well, 2016 they made 2.5 billion, 2017 2.8 billion. Oh wow, they had a massive jump in 2018 up to 4 billion, 4.5 billion. So they're doing pretty well. They're moving in the right direction for me. Okay, so if I see a company that's making money, okay, that's bar one. We can start there. Okay. Now what I want to do is I want to look at a couple other things. I want to delve a little bit deeper here. I want to look at the balance sheet and I want to ask myself some questions. If a company has more debt than they have assets, is that long-term a good thing? I'm going to say probably not. I won't say for sure because some companies have a lot of research and stuff where they spend a lot of debt, and sometimes that works out really well, sometimes it doesn't. But for me, my kind of personal rule is I need more assets than I need liabilities. Okay, and so I just go make this very simple. I come and I look at the total assets. Okay, total assets, they got 61 billion. And then I look at the liabilities, and I say, okay, they got 35 billion, 36 billion. Okay, so at the end of the day, they could sell off all their assets, pay off all their liabilities, and they're still sitting at what, 30 some billion? 61, yeah, it's not quite 30 billion, but 25 billion. Well, that to me sounds like a pretty good company. If you've got 60 billion, if push came to shove, or sorry, 30 billion left over when it's all said and done. That seems pretty okay to me. Okay, so little simple tools like that are taking the long-term investing part of me and saying, okay, so far right now, as I see it, and for at least the last 4 years, this particular stock has been moving in the right direction. Okay, now you can do a covered call on this. For those who don't know, covered call, basically you got to buy 100 shares. That's one contract, and then you're going to sell a contract, and we'll get into that actual trade in a minute here. So for this, if you bought the stock tomorrow at 1880, you're gonna tie up $1,880 to do one covered call. That barrier to entry, I think, is available for everybody. Okay, like if you're not starting out with more than $1,800 in your trading, then what I would suggest is you paper trade and build up your bankroll a little bit, because obviously you're going to want a little bit more than that for drawdowns and all the rest of that. But I think a barrier to entry, $1,800, I think that's fair. Okay, and so so far we've seen that this thing actually makes money. It continues to make more money each year. It's got a lot of assets, which is good. And now I just want to look at cash flow. One of the last things I like to look at here is called free cash flow. Okay, so what I'm looking for here is if trouble comes, okay, we as traders and investors, we're always watching the economy. Okay, if trouble comes, I want to know whether this company is going to survive that trouble. Well, one of the best ways to survive problems is to have lots of cash on hand. So you can see here from 2016, they went from 1 billion cash on hand, almost up to 2 billion cash on hand now. Okay, so what this tells me is they got some money set aside for a rainy day. They've got more assets than liabilities, and they keep making more money each year. Well, so far, I'd say that's pretty solid. Okay, so again, this, I'm just looking at the long-term investor portion of this. Okay, I'm going to get to the trading part in a few minutes here, but I want to run through these things because I want to make sure that if I'm holding this thing for the next 10 years, is it trending in the right direction? It's the same thing we look at when we look at a chart, right? If we're looking at a chart and we're doing a covered call, it's a bullish strategy. So I need that thing to be either going bullish or at least at the very minimum going sideways. Okay, I need that thing to be running in a certain direction. So I look at this and I say, okay, that gives me an idea there. So I got one other little place I like to go, a little website here where I'm going to check and see if this company rewards me as a shareholder. Okay, if it rewards me as a shareholder, then we can have a discussion about maybe buying into it. Okay, if it doesn't, again, this is my personal rule. It doesn't work for everybody. If they don't pay me to be a shareholder, I don't own the stock. That's my own personal rule. Okay, now that may not be your rule, but like I said, I want to be rewarded for giving them my money. Okay, and essentially what a share is you throw them some cash, they throw you a piece of the business, and I want to be rewarded for that. Okay, so little website I use here. It gives you a great bunch of information in a very, very short period of time. We can see that the trailing 12-month dividend yield right now is about 9.79%. Okay, that's a little high. Okay, that's very high right now. They're projecting it to be even higher. The average is about 6 or 7%. Okay, so little tip about yields. 3 to 4 to 5%, very healthy. Obviously, we've had a pullback in February there that juiced up the returns. You have to be very careful when you see some really high yielding companies, because sometimes they can't support that. Now, one of the ways to know if they can support it or not is something called the dividend payout ratio. You guys can see that right there. That says 84%. What that means essentially is that 84% of earnings is going to pay their dividend. Okay, so we already figured out that they got $2 billion on hand, so they could pay a lot of dividends for a while, but they're paying out 84% of what they make to dividends. So they still got that 16% cushion. I'd like to see that quite a bit lower, but this is actually a limited partnership as well, so it's a little bit different, but you're going to see a higher number there anyway. But the reality is these guys have the ability to continue to pay that dividend. They have the ability to reward us as shareholders. So again, this makes me kind of feel good about holding this thing longer term. Okay. So when I'm looking at this, a couple other things I want to look at. I want to see when the first dividend's paid. Okay. I want to see how long these guys have been paying dividends. Do they have a track record, right? So 1998. Between 1998 and now, we had the crash of 2000. We had the crash of 2008. We've had some economic challenges between then and now, and they've been paying dividends pretty much nonstop since then. You can see here that they've also increased their dividend every year for 19 years. Okay, so we got a nice little bar chart here, and you can see that they're rewarding their shareholders quite nicely. Okay, so just very quickly there, I've satisfied the thought process of the long-term investor. Now, does this mean I'm going to buy this and hold it forever if something changes? No, that's not what it means. What it means is right now, I look at this and it seems pretty solid to me. I'm always going to keep an eye on this. I'm going to have a set time to check and see that the company's still doing what I expect them to do. Okay. And so just looking at something like this, it's a $19 stock. Okay. They make money. They do quite well. Okay. They reward you as a shareholder. They've got some good qualities there. So now I can go in and I can look at the chart here. Okay. EPD. Okay. And I can say, okay, well, what's happening here? All right. Well, we just went past earnings. So looks like they did okay. They beat their earnings. They just paid their distribution there. And so from left to right, you can kind of see that it's working its way higher. It's above all the moving averages that I happen to have on here. So it's not screamingly bullish, but as I said before, we're happy with bullish or, ideally slightly bullish, or even we can get by on neutral. Now, I'd prefer slightly bullish. And I would say, if you asked me, looking at this chart, if you're above all the moving averages and you're sloping to the upside, I would say that's bullish. So now we have an idea that says, okay, we've got a decent stock. It's going in the right direction. Now, is it something we can cash flow? Okay, so we could sit there back and collect that 9% dividend. Okay, or we could get in there and we could say, okay, can we do better? Okay, and I think we can do better. So let's take a look. So then I want to go to my trade tab. Like I said, very simply, a covered call means I'm buying 100 shares of this stock. Okay, pay $18.80 for this stock, and then my job is to go sell what's called a covered call. Okay, so all I'm doing to make this as simple as possible, the way it was described to me by one of my mentors was, you're making a promise to do something. Okay, in this case, I'm making a promise to sell my stock to somebody at some certain time in the future. Okay. I had said before, I like 30 days because I understand that the time decay from 30 days to zero is the fastest that it possibly is. Well, I don't mind making a promise to do something, but I also like getting paid to make that promise. And I also like it if I don't have to fulfill that promise. Okay. So if you think about it as an insurance company, okay, you pay your car insurance and you drive for that full year or whatever, you don't crack it up, they keep all the money. Okay, well, I kind of like to do that same thing, and I like to get paid monthly the same as they do. So I look right around that 30-day mark. So in this case, I'm going to go to September 11th. Okay, now I have a rule. I like to go at least a 40 delta or less. Okay, so for those of you not versed in delta, basically, this is the odds of an option basically getting touched, I guess it is. So if I go with a 40 delta, there's probably about a 60% probability, not quite 60%, but that ballpark that it's not going to hit my strike price. So in this case, I don't have a 40, but I got a 45 and I got a 35. Okay, so I'm going to go to the 35 here. Now, if you're more conservative, you can, obviously everybody's going to have their own rules. If you're more conservative, you could go with a 20 delta, 15 delta, whatever you want. The key to these trades, okay, is you have to match the premium versus the amount of money you take in versus the safety or the security that you're going to get. Okay, so in this case, I don't mind going with under a 40 delta, which would be the 35. So that means I'm going to make a promise to whomever. Okay, it's going to be somebody on the other side of the trade. I'm going to make a promise that they could take my shares at $19.50. Okay, so $19.50. If I bought it at $18.80 and they take it from me at $19.50, am I happy? Sure I am. Absolutely. Okay. So now if I do that, I can turn around and I can sell this and they're going to pay me 41 cents just to make this promise to sell my shares for the next 30 days. Okay. Now we talked about long-term investing and holding this and all that kind of stuff. Okay. If you like this stock and you want to hold it long-term, sorry about that. You want to hold it long-term, you don't have to let your promises, you don't have to fulfill your promises. If you wanted to hold on to the stock and you think it's going to climb, you could always buy those promises back. I'm not going to go down that rabbit hole tonight because I don't have that much time. But the reality is, I looked at it from a long-term perspective because if my stock doesn't get taken away, that means I'm going to hold it longer. So that's what I was doing when I went through that little look-see to make sure that, okay, if I got to hold this thing, if it doesn't go to where my strike price is, if I got to hold it, am I okay to hold it? And as we went through, you could see that it was something that I was okay to hold. So if we think about this, so if we got 41 cents, let me get my little calculator out here. Got to spell calculator first. There we go. Now, hopefully you guys can see the calculator. If not, I'll just talk it through anyway. So if we get 41 cents, all right, and we divide that by the cost of the shares. Now, again, I'm not going to go into margin or anything like that. Obviously, they're not going to withhold the same amount if you've got a margin account. But the beauty of this as well, and another thing that I get asked very often, if you've got a retirement account like an IRA or RSP or TSFA, where I live in Canada here, you can do these, for the most part, you can do these strategies. Okay, covered calls are very basic strategies. So if we divide that by 1880, okay, just to get a number in our heads here. Oh, that's not the right number. So 0.41 divided by 1880, that's better. So we're looking at about 2.18%. Okay, so 2% for 30 days. That's 2% a month. Okay, now you may not get to do this every month. Okay, there's going to be earnings, and there's going to be all sorts of different things. But even if you could do this for 6 months out of the year, if you did this trade 6 months a year, that's 12%. Well, this was paying a 9% dividend, almost a 10% dividend. You add that 10% onto that 12%. Wow, you've got some crazy digits there. Okay, now you're always going to have ups and downs. There may be times where you're not selling. So like I said, if we only sold this 6 times a year, that's a pretty darn good return. Okay, so this is that enhancement for that longer term perspective that I was talking about. All we're trying to do is geek this up a little bit. Okay, so you start thinking about compounding here. Okay, if you made, say, let's be so ultra conservative here. If you made 12 to 14% a year, okay, you're going to double your money. It was probably every 5 to 6 years. Okay, so that's being pretty ultra conservative, right? If you are able to do this, say, even 9 times a year, right, you're starting to look at some really big numbers there, and compound interest can really, like I said, those numbers can really blow your mind. Okay, and as you can see, this is a very liquid stock. Okay, we have to make sure that it's tradable. Well, there was 12.5 million shares traded today, so there's obviously people that trade this. It has weekly options, so there's that tells us that people are willing to trade it. Now we'd have to look at the volume and open interest. Well, look at that, it's got thousands of contracts. Okay, so it's definitely something that's in play, and you can see that there's money to be made here. Okay, now I didn't actually check for earnings. Yeah, so earnings has gone by. Okay, so earnings has gone by, and that's the trade we're looking at. Okay, so again, that's how you start out looking at maybe a longer term perspective. So I got a couple other stocks here that I'm gonna talk about. Now this, I'm gonna get away from our investor / longer term focus, and I'm just gonna look at the trader perspective. So 2% on a covered call, well, that's okay for some, but like I said, there's folks out there, traders, actual traders, who are looking for more than that. They're looking for the 3, 4, 5, 6%. Now, maybe you guys could tell me, have you guys all heard of Under Armour? You guys type in the chat box for me. Let's make this interactive. I'm pretty sure you've all heard of Under Armour. Okay, it's a pretty well-known company. You know, almost 5.5 million shares traded today. It's under $10. Okay, it's under $10. So this is a stock where people with a smaller account can still get involved. Now, I don't know about Under Armour. I didn't look at the fundamentals of it. I would actually before I did this trade, but it's probably not one like EPD that I'm going to keep long term. Okay, what I'm looking for here is a little more bang for my buck. Okay, I'm looking for a little bit of juice here. Okay, so if we look at this again, so now I'm putting on my trader hat. I'm taking off the long-term investor. I'm looking at the trader hat. I'm saying, how much can I get each month out of something like Under Armour with a small price tag? For $10, like I said, you could put it. You could even in a cash account, a cash IRA or cash RSP. You could do this trade for under $1,000. Okay, and most folks that are trading, unless they're starting out, you know, trading maybe Forex or something, they're probably going to have a little more, hopefully, than $1,000 to start trading with. Okay, so there's the barrier to entry is very low here. So let's take a look at this, and again, so I could go look at the fundamentals of this. I'm less concerned about that because I don't plan on holding this for years. I plan on holding this for you know, a month or so. Okay. And I might redo it again. So I want to look at this. And I want to say, okay, let's look at this and see if it's doing what we want it to do. Okay, well, it's not as bullish as I would like it to be. It is, however, working its way higher. Okay, a little bit of a channel here. You know, it's not the most bullish stock, but did come down, found channel resistance there and moving up. This would qualify under our bullish to neutral bias. Okay, so let's see if there's more money in this than there was in our EPD. Okay, so again, I'm going to use the same rules as I used before. Like I said, you may have, you know, different rules, whatever. I'm going to look for my 40 delta here. 37 delta is the best I could get. So I buy this at 977 tomorrow morning, maybe even actually a little bit cheaper if depending on the bid. I buy this tomorrow morning. I go to my 37 delta. I can sell it for 10.5. Okay, so what are we looking at there? About 80 cents, maybe 80-cent capital gain if it gets taken away. And then I drop in there and I'm going to get 40 cents for this. Okay, so now we just got 40 cents for an $18 stock. Now we're getting 40 cents for a $9 stock. So let's say we bought this tomorrow morning. 977 divided by 0.40. Nope, that didn't work. You can always tell when the numbers are weird. So 0.40 divided by 977 times 100. All right, so now we're looking at basically 4.1%. Okay, that's the juice I was talking about. Okay. You start doing this 6 times a year, okay, you're looking at 24%. Now, I don't even know if Under Armour pays a dividend, but the reality is even if you just sold covered calls 6 times a year, which again, you could probably do more than that, but I'm trying to be conservative here, 4% each month. Now, again, I want to be fair here too. You're not always going to get this exact amount. There is fluctuation. Sometimes you get a little higher, you get a little bit lower. Okay, but this is a company that everybody knows and understands, and yet we still have the ability to turn around and make 4.1% on it. Okay, now for this one here, like I said, I don't know about the fundamentals. So maybe take a quick look at it. Okay, I'm gonna want to manage this quite a bit differently than I manage the other one. I'm not going to ride through too many rough spots with this. You know, I'm going to be, you know, if I'm prepping this trade, I'm going to be looking at a bunch of different things. I'm going to want to pick a spot here. Say, okay, if it gets below, you know, let's say it gets below the 50 MA, you know, the 909, I'm probably checking out. Or if it breaks this trend line resistance, I'm probably getting out. Okay, and I'm going to want to set that stop loss because the reality is, like I said, I don't know if this is awesome from a money standpoint or fundamental standpoint, but I also know that if I'm going to get a 4% rate of return, it's probably not going to be quite as strong as the ones that I get 0.12%. Okay, but let's just for giggles here, just take a quick look, see if they pay dividends. I don't know if they do or not. Okay, so right then and there, this is where we take our trader hat versus our investor hat. They don't pay a dividend at all. They don't reward their shareholders. Okay, so for me, that's one that I don't mind going after some money, on a monthly basis, but I'm also not going to hold it long term. So this is where I'm going to either hedge it in some manner, or I'm going to have a stop loss on the whole trade. Okay, one of the things that folks they don't always notice this as well, though. If I sell this covered call up here and it does go against me, okay, I'm actually going to make some of that covered call premium to offset some of my risk to the downside as well. So that's something you got to take into consideration, right? If I sold the 10.5 up here, okay, and it pulled back to 9, well, a lot of that premium is going to come out, and that's going to go in my pocket. So, if we got in at 977, and let's say we got out at what did I have there? 909 was under the 50 MA. So let's say we got out at 909. So there's what's that look like? About what about 67 cents or so risk. Well, if I'm getting 40 cents in covered call premium, okay, then as it pulls down to 9, I'm going to get a little bit of that. So my risk is actually even lower than that. Okay, and so you can throw on this trade here. We can look at this, analyze the trade. And so this is something you want to think about. Is you want to look, if I can pull up the risk graph here. Okay, something doesn't seem quite right here. Let's make sure I got this going on. Okay, cover call. Yep. Okay, so I don't have the stock in here. Let me throw the stock in there. Let's just do it right. All right, go back to the risk profile. That's why it didn't look right. Okay, so you can see here, if it got down to that 909, let's go to our 909 here. Okay, let's say that was our stop loss. Okay, $46. Okay, so I'm not risking that full 60, whatever it was, 68 cents, whatever it was. I'm not risking the whole thing because my covered call is going to offset some risk. So when you start thinking about it from a trader perspective, if I'm not willing to own the stock, which in this case, like I said, doesn't pay a dividend, so I don't really want to own it that long anyway. But you can see that a $10 stock can get you 4% a month. Okay, and these are not that hard to find. Okay, UA is not, like I said, I don't mind the chart. It's working its way higher. There's probably better. I remember one that we had we used a few years ago. $5 stock here, GoPro. Okay, GoPro's not looking that great right now as far as I'm concerned. I don't like the fact that it just broke its trend line resistance. Let me draw a better line here. Okay, broke below those there. So this would be a non-starter, but say a week ago, right? Had this been able to break out above 580, that would have been a great cover call candidate. However, we've got some crossover, so it's not running the way we want, but it's a $5 stock as well. So let's look at the trade tab for this. Okay, you want to see some juice here. Okay, sell the 40. Yeah, you wouldn't be able to sell the 40 delta because there is no 40 delta, but well, maybe we could check another expiration here. Let's go to 37. So let's go to 37. Yeah, there's nothing real close there. So, but even here, you could get 19 cents on a $4 stock, $4.70 stock. So let's see what that comes out to. 19 cents divided by 477. Yeah, so you're 4% on a $4 stock. So the ability to use a small account and start to work things out, start to build some capital, you can do that with these lower dollar stocks. Okay. Another one I picked out was Sirius, $6 stock. Okay. 21 million shares traded. So very, very liquid. Okay. I like the pattern here, right? It's moving in the right direction. It's where we want it to go. Again, I've never looked into the fundamentals of that. I'm just saying there are these abilities out there to go out and find these lower dollar stocks and still make some money off them. Let's see if there's any money in the options here. Okay. First thing I might want to check is the volume open interest here. Okay. Look at that. Thousands and thousands of contracts. Now, the only part about this, and this is what disqualifies this, there's no money in it. Okay. Now that's for the 7. Maybe we can get some out of the weekly. Let's see what we can get out of the weekly. Might be able to get a little bit out of this. Yeah. So unfortunately, this is a non-starter. Okay. There's 100 contracts of open interest, but there's no money to it. Okay. So that's a non-starter. We'll dump that one. MRO. So Marathon Oil Corporation, $6 stock. Let's see if they got any money. All right. 30 days out. Lots of contracts of open interest. Where's my deltas? Delta 36, going to get 24 cents out of that at a $5 stock. Let's do some quick math here. 24 divided by, what was that number? 597, 598, 4%. So Marathon Oil, right? Oil company. Oil's kind of making a little bit of a comeback. You're looking at 4% for 30 days. Okay. So you can see that, and obviously there's a million other choices here. We could go really big dollar stocks, all that kind of stuff. I really wanted to demonstrate that it doesn't take a lot of money to make money. You know what I mean? You can start with a smaller bankroll, and you can work your way up, and you can use it by splitting up that trader mindset. Okay. Like, let me bring back my whiteboard if it's still there. Okay. You can start with a trader's mindset where you're starting to work on these ROIs. You're starting to get that 4.5% per month. And then you can roll that into some long-term decent companies. Okay. So got some questions here. Matt Justice, me and old Crow had a nasty volatile marriage. Yeah, that's I actually remember that as well, Matt. So, but like I said, what I wanted to convey today, I guess, it depends on what time zone you're in, is that you can start small and work your way big. And I think the key is, and I think Matt's can talk a little bit about this later on, is compounding your gains. So if you start getting 4% on a Marathon Oil, or you start getting 4% on a UA, and you start taking that money and you start driving it into, some good high quality fundamental companies, you can start to build yourself a really, really nice portfolio. Okay. And it wasn't just EPD. There's a few other ones that I have, but if you start looking for these stocks, and you start going into their value and their fundamentals and what they do, you know what I mean? You can start to really build yourself out a portfolio, and you can really compound that interest. You can blow it up to a big number if you just work at it. And that's the beauty of the covered call system. It's not hard. It takes some education, some learning, and some mastery. Okay. Especially when you want to start rolling. Okay. So, as I talked about in the first one there, if we go back to the EPD example, I got to get out of that whiteboard first. Okay. Go back to the EPD. Like I said, maybe you're one of the folks that want to keep it, right? Maybe you want that dividend. Okay. Well, that's where things start to get a little bit more complex, but still not anything that you can't handle. If I sold the 19.5 here, what I would do is as soon as it got past the short strike, and I'd have it maybe a percentage of the ATR or whatever you decide. Once it gets past there, then I can buy that promise back that I originally made, and I can roll it out to another one. And that way I will hold on to the stock. Now, you may have to give some of that money back sometimes, but a lot of the time, if you give them more time, you'll actually get credits for that as well. So there's all these different ways to set yourself up so that you can start that compounding movement. So if you're just starting out, maybe you got a tax-free account and you're just starting out. Like I said, most of the ones that I know of will allow you to do covered calls because it is a reasonably safe strategy. So dig into the fundamentals of the company if you plan to hold it. If you're trading it, make sure that you've got a really healthy exit plan. Whether you're going to, like I said, maybe you're going to short some stock or maybe you're going to use an option to protect the downside, or maybe just use a stop loss. Stop losses are easy. You can get out very quickly and just move on to the next trade. Okay. And if you're going to do that stuff, like I said, think about the deltas you're using. I was just showing you guys the, less than 40 delta. If you're a little bit more conservative, look and see if there's any money in a 30 delta. There's no problem with going a little bit further out, being a little bit more conservative, because the game here, the trading part of it, you're trying to build up that bankroll pretty quickly. The long-term investing part, you're trying to build up that portfolio slowly. Okay, add more shares, right? Take that money that you get every month. If we were selling the EPD, I forget what would we get for that one there? Let me just quickly look there. So what we're going to get there, we're going to get 41 cents for that. Okay, so $41. Okay, you get $41. All of a sudden, you can buy another 2 shares per month. Okay, and then maybe you're kicking in a couple of bucks per month, right? Maybe you're adding to your bankroll each month. All of a sudden, it's not going to be too long before you get to more contracts and more premium.